Have you ever heard the phrase all risk insurance? It's a product that's available in the freight and transportation marketplace, and it's becoming more and more prevalent. In this quick video, I'm going to explain to you what it is and how you can use it to add values to your customers. Welcome back to our channel, and if you're new here, welcome to our channel. I'm Nate with Freight 360, and in this week's video, we're teaching you all about insurance. If you're new to our channel, don't forget to like this video, subscribe to our channel, and hit that notification icon to make sure you stay up to date on our latest content. So, what is all risk insurance? Anytime that we're transporting freight, we need to make sure that the motor carrier that we're contracting has the proper level of primary cargo insurance. Now, in most cases, you're going to see that a carrier is going to have $100,000 in coverage. Now, if there's a damage to the shipment or a claim of any sort and the carrier is at fault, it's that insurance policy that is there to cover the cost of that loss to the customer's freight. This sounds simple, but in reality, claims can take months to settle, which can frustrate your customers. That's exactly why the all-risk policy was created. In addition to the carrier's primary cargo insurance policy, freight brokers and shippers can purchase single load policies that cover that specific shipment at hand. These policies, they're not to be used in lieu of a carrier's policy, but rather they're there as an added level of protection with benefits that can take a lot of the pain and headache out of a freight claim. What's cool about the all-risk policy is that they take what's called the first position in the event of a freight claim. What that means is that the all-risk policy can pay out a claim very quickly, usually within 30 days, and then they can go through a long claims process with the carrier's actual policy to recoup their money that they paid out. Let's take a look at an example. All right, we'll take a claim here and how the all-risk policy would apply. Let's say your customer ships lettuce, and the value of the shipment is somewhere around $50,000. You contract a carrier to haul that load, you verify that they have all the proper cargo insurance. Additionally, you purchase an all-risk policy for that load specifically that covers the lettuce in the event of a claim. The price for these policies can vary depending on a variety of factors, but let's say you paid $50 for this additional coverage. Now, while in transit, the reefer unit breaks down or has some sort of issue that causes the temperature to rise too high, resulting in the lettuce being partially spoiled. The receiver makes a note of the damages, and now you need to file a claim on the carrier's insurance to reimburse your customer for their loss. Normally, you would expect to spend months going back and forth with a shipper, carrier, receiver, and possibly a third party like the USDA or Blue Book services to determine the cause and fault for this claim. Meanwhile, your customer is upset because they've suffered a loss on their product and they still have a freight bill to pay you for. This is where the all-risk policy can help ease the pain. Rather than wait upwards of 4 to 6 months in a claims dispute, you file a simple claim with the all-risk policy, which was purchased to cover this shipment alone, and they pay out the claim to your customer quickly, usually within a few weeks like I mentioned before. Your customer is taken care of even before their freight invoice is due. Now, after that claim is completed and paid, the all-risk company that you bought the policy through, they can then go through that 4 to 6 month process of trying to settle that claim that they just paid out to you, but with the motor carrier's insurance company this time, who's ultimately liable for the damages or losses. All we're doing here is simply adding a second insurance policy in place for a very minimal cost to ease the headaches that come into play with the inevitable claims that we run into shipping freight, especially freight that has higher likelihood of claims like fresh produce. Now, some considerations here. Like all insurance policies, every policy is different. Some primary cargo policies exclude coverage for specific commodities, such as frozen seafood, berries, or other perishable goods. The same thing applies for these all-risk policies. So if you're shopping for rates on an all-risk policy, you need to make sure that that policy does not exclude the commodity that you're shopping for and that you're going to be shipping. Additionally, the carrier's insurance needs to also cover that commodity, since the all-risk company is eventually going to recoup their money from that carrier's insurance company. You confused yet? Don't worry. Luckily, we've done all the research for you, and we've been able to identify a trusted provider of all-risk insurance policies in the freight and shipping industry. DAT is a trusted partner of us, and they've partnered with LoadSure to provide quick and easy access to all risk insurance policies at the click of a button and typically less than 1 minute. You might be wondering, why would you want to spend extra money for insurance when the carrier's insurance already covers your customer's load? Think of it this way. Your customer knows claims are going to happen from time to time. Now, what's different between you and other brokers is that you've taken the extra step to speed up that process to reimburse them, reduce the headaches that come within our industry. So to learn more about all risk policies, make sure to check out our entire library of content and listen to a full podcast episode and a video demo that explains these policies and shows you just how simple it is to go the extra mile in protecting your customer. Thanks for watching, and we'll see you in the next video.